In today's episode, I'll talk about two stories. In the first story of the day, I'll talk about a research done by Anthropic AI, which is the company behind Claude, on the future of AI and jobs. And in the second story of the day, I'll talk about a recent draft regulation by the Competition Commission of India that many people believe might change the country's competitive landscape. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 19th of February. See, recently, Anthropic, which is the company behind the AI assistant Claude, studied how people use one of their AI tools. They basically looked at millions of conversations that people have had with Claude in order to figure out what kind of tasks people hand over to AI and how deeply AI is actually woven into their day-to-day jobs. Now, this is interesting because until now, we've mostly heard guesses and speculation about AI's impact of work, but we didn't really have any large-scale data to confirm these guesses. But now there is clear evidence to show who is really using AI the most, how people are using it, and in which fields they're using it. Now, the first thing they found is that people working with information are the primary users of AI. Now, this includes writing tasks, coding, and also mathematical jobs. In fact, a little under half of all the work done on AI tools like Claude happens in these very areas. And it makes sense when you think about it, because AI deals with information at the end of the day. It helps write or fix code, and it can also process text more quickly than most humans could do on their own. On the other hand, jobs which require physical presence like construction or hands-on care like healthcare support, etc., barely appear in the data. Another part of the study reveals a kind of sweet spot in terms of income. See, when you compare people's salaries with how much they use AI, you will see a spike in usage among those people who earn decent amount of money and also have jobs that require 4-year bachelor's degrees such as software development. Now, these roles pay fairly well. In the US, they are often in the range of $70,000 to $100,000 every year. Meanwhile, workers at the highest levels like medical super specialists hardly use AI. And this is likely because their fields involve strict regulations and also demands for human-led expertise. And on the other hand, people in lower wage jobs like certain service roles also do not use AI much because more often than not, these roles involve physical tasks that AI just cannot handle, at least as of now. Now, moving on, when it comes to how AI fits into people's work, there are generally two ways how this happens. First, some people use it to do an entire task automatically, while some others actually rely on it to help them think a little better. Now, surprisingly, the latter actually happens more often. More than half of the time, people are working alongside AI, they are talking to it and asking it for suggestions. They are letting AI refine their writing or designs, and then they are deciding on the final outcome themselves. In other words, basically, they are using AI more like a partner than as a replacement right now. The 43% or so people who let AI handle entire tasks usually give it jobs that are predictable and don't really need much creative judgment, like reformatting a document or finding small mistakes in code. So the one big question that almost everybody across this world has, which is, will AI take my job entirely? Well, the answer is the data does not really give us a final answer, but it does suggest a good pattern. Most jobs do use AI, but only for some of their tasks. In a little more than half the jobs, at least 10% of the work is given to AI. Yet, in only a very small fraction of these jobs do people actually hand over more than 75% of their tasks to AI. Even among those people who learn on AI quite a bit, it seems to be an add-on rather than a total replacement altogether. So while AI might not fully take over your job right now, it could become a helpful sidekick of sorts that boosts your productivity. And finally, the data also highlights where AI really shines and where it also falls short. See, AI is great at things like reading and understanding text, generating ideas, coding, and solving certain kinds of problems. But it does struggle with tasks that need physical skill, a strong emotional or social connection, or a careful kind of leadership. Now, these limitations are very important to keep in mind. They show that although AI is advancing very quickly, it still cannot really do everything that a human being can, especially in areas that require hands-on involvement or deep interpersonal understanding. So that's the broad picture. Now, I understand this might be very obvious to all of us right now, but now we finally have actual data to show us who is using AI, which tasks are being automated, and which ones remain firmly in human hands. And also, we understand how AI is really settling into people's everyday routine. routines now. Coding and writing tasks, along with other information-based work, remain the main use cases here. All of this put together means that for most of us at least, AI is not really likely to steal our jobs at least anytime soon. It is very likely though that it will continue to evolve into a tool that makes us work smarter and not less in any manner. With that, let's move on to the next story of the day and talk about a new draft regulation from the Competition Commission of India, or the CCI, that many people believe might change the country's competitive landscape. But to understand why this is important, let's very quickly understand what the CCI exactly does. See, it is the authority in India that watches over businesses to ensure that no single firm unfairly dominates the market and that consumers and smaller competitors are not really harmed by anti-competitive behavior. Now, at the heart of this discussion is an idea from an economic theory called perfect competition. See, in a perfectly competitive world, there would be many companies all working efficiently and consumers would know exactly what they are paying for. But the thing is, in reality, markets rarely match this need description and companies can become powerful in ways that go beyond this fair rivalry. And this is why people often refer to the writings of Friedrich A. Hayek, the Nobel Prize winning economist, who argued that the notion of perfect competition, where everything is frictionless, does not really reflect how competition actually works. What truly matters in the real world is whether a firm is abusing its dominance or not. Now see, being dominant in itself is not really illegal. A company might grow because it has better products, or it has cheaper processes, or more innovative ideas for that matter. But trouble really starts when the company uses it to harm competitors and bend the rules of the markets in its own favor. A very common example is when a group of businesses form a cartel and they agree to fix prices in a way that hurts consumer. Now that is easier to spot and prove in court because it directly raises costs for consumers. But the thing is, there is a murkier practice called predatory pricing. And this is where a firm sells its product or services below cost in order to drive out competitors. Now this may seem like a good deal for shoppers in the short run because prices are very low. But in the long run, smaller companies may actually be pushed to the edge and also forced to shut down in many cases. This would let bigger players raise prices later and also recoup all of their previous losses. One very famous example is when Amazon and diapers.com went head to head. Basically, Amazon had dropped the prices of diapers significantly, and diapers.com could not really keep cutting prices without suffering huge financial losses. So it eventually lost to Amazon's relentless pricing strategy and was eventually bought by Amazon, after which diaper prices went up once again. So in order to tackle problems like predatory pricing, the CCI has now introduced a draft regulation that tries to define more clearly what selling below cost really means. Now this regulation explains different ways of measuring costs like average variable cost, average total cost, long run average incremental cost, and average avoidable cost. Each of these offers a different way to check whether or not a company might be setting its prices too low on purpose. Now, in theory, this should definitely help the CCI spot anti-competitive behavior very easily. But that said, really showing and proving that a company is intending to drive out its competitors, it's not really as simple as we think it is. Firms do not really openly admit that they are trying to destroy rivals. They use terms like customer acquisition or market penetration to explain why prices are so low. Regulators then have to piece together a lot of proofs of predatory strategy from documents, messages, and other clues. In addition to that, what looks predatory to one person might just be tough competition to one other. Businesses like Uber and Zomato, for example, usually keep their prices low in order to attract more customers to their platform. Now, the big question is that a clever growth strategy or something more sinister? Some experts say that predatory pricing, especially in our digital age today, might not be as damaging as once we thought so. A firm that tries to sell below cost for too long will lose more money than its smaller competitors, which is not really a clever thing to do unless it can be very sure of recovering those losses later. And in fast-moving industries, new players can emerge very quickly if prices start to spike again. So the benefit of driving out old rivals might not really last too long. But on the other hand, some others argue that although it might be rare or hard to prove, it can still harm the economy's competitive spirit if it is left unchecked. So the CCI's new regulation aims to bring out some clarity, but the thing is, it might not really change the market dramatically. Big companies are definitely at this point skilled at explaining that their low prices are a part of normal business plans, and regulators usually also hesitate before stepping in here. Also, the digital world is evolving very quickly, so rules that were based on traditional definitions of cost might not really capture modern pricing tactics. And for these reasons, this particular draft regulation bill could be seen as a step forward, but it may not entirely solve the challenges of spotting and stopping predatory pricing. That brings us to the end of the two stories of the day. Let's now move on to the final section, which is the quick news headlines. First, Tata Capital is set to raise 15,000 crore rupees through green bonds and non-convertible debentures. Here, 10,000 crore rupees are earmarked for green bonds, market-linked NCDs on a private placement basis, and 5,000 crore rupees via secured redeemable NCDs. This comes in as the company prepares for its mandatory IPO by September 2025 following RBI's upper layer NBFC classification. Second, India's merchandise trade deficit widened to 22.99 billion US dollars in January 2025, exceeding economists' projections of 22.35 billion dollars. Exports fell to 36.43 billion dollars, down from 38.01 billion in December and 37.32 billion 1 year ago. Imports, on the other hand, rose to 59.42 billion, up from 53.88 billion in January 2024. Third, NTPC plans to build 30 gigawatt of nuclear power capacity over the next 2 decades. They want to triple their initial 10 gigawatt target after the government opened this sector to private and foreign investment. The expansion, requiring a 62 billion US dollar investment, aligns with India's goal of 100 gigawatt nuclear capacity by 2047 and 500 gigawatt non-fossil fuel power by the year 2030. Currently speaking, India's nuclear capacity stands at 8 gigawatts solely operated by NPCIL, which aims to increase it to 20 gigawatts by 2032. That's all the news and stories I have for you today. I hope you enjoyed this episode. I will see you in the next one. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.